Hey everybody, welcome back to AIME Live. We are here once again with one of the industry leaders and experts. This is a series that we're doing throughout the year this year. There's only 21 of these happening, so of course we had to get Barry Habib in as quickly as possible. My name is Katie Sweeney. I am the CEO over here at AIME. Barry, thank you so much for joining me.
It's always great to be with you, Katie.
We're very excited. We talked to you about a year ago, right when COVID-19 was first hitting. The market went nuts. My birthday party was canceled. Everybody went crazy in late March last year. Crazy volatility, lots of unknown, and you had the guidance to get us through all of it. So here we are a year later talking about this yet again. What do we have on the horizon for rates going into Q2?
It's definitely a changing environment. So it doesn't mean that the ride's over. You just have to change your focus. So you asked about rates. So we see interest rates moving a little higher, and the main reason and the main culprit's going to be inflationary fears. Inflation drives interest rates. That's an important thing for us to understand. If you are the recipient of the payments of a bond, like a mortgage, that's a fixed amount that you're getting in most cases over a long period of time. So the buying power you get from that fixed payment gets eroded as inflation pushes prices higher, making things cost more. So you get the same money, but it buys you a little bit less because of inflation. When inflation is very low, you don't need as high an interest rate because your buying power remains pretty much intact. But as inflation is either perceived to rise or as it actually starts to rise, just like we're seeing right now, we're seeing interest rates have to move higher because investors have to receive higher compensation for the more rapid erosion of their buying power. And when we take a look at currently, inflation is very low. So why are rates going up? It's the perception that inflation is about to rise. We haven't actually seen the evidence of it yet. As we approach, I would say, May, June, and July, we're going to get the inflation readings for respectively a month earlier, April, May, and June. The current level of inflation is at 1.3%. That's really tame. But watch what happens as we get over the summer. You're going to see inflation rise to about 2.5%. So if somebody's quoting an interest rate today, let's just take a number, 3.25 with 1.3% inflation. That's elevated a little bit because the perception that inflation is rising, but when we actually see the numbers, you're not going to get 3.25 with 2.5% inflation. So we forecast that over the summer, rates will probably move towards 3.75. Maybe it's 3.625, maybe it's 3.875, but they will be in that range. So what's our strategy? Customers today, they're like butthurt, they're like crybabies. So they're like, oh, I wanted a rate under 3, so I'm not going to do it. Duh. If it makes sense, you should do it. Well, I want to wait for them to come back down. Now, I want to give you the good news. The good news is that I do think we will see lower rates, and I do think they come down. I'm going to explain all that in just a minute. But first, the strategy when you're talking to a customer, you have to do the math. And we've got tools like this in MBS Highway, but you can do the math manually. If you are going to save somebody, let's just say $300 or $400 a month on a refinance when your rate was back at 2.75, and now the rate's at 3.25. So maybe you could save them $275 a month. They're going to be crying in their soup saying, oh, I really wanted to save $400 a month, but it doesn't mean the $275 a month is bad. And by the way, if it takes a year or 10 months for interest rates, if they come back down to those levels, what about the $275 a month that you could have been saving with a $300 a month for 10 months?
The entire time.
$3,000. How long would it take for that incremental $50 or $100 a month to make up for the difference? A long time. You're talking 3 years, 4 years, if it happens. So this is the strategy that we have to have. Now, I did mention that I think that rates are going to cycle back down. So Katie, here's some quick numbers. When we looked a year ago, you started this off by talking about a year ago, and sorry your birthday party was canceled.
That's all right. We made up for it with another one this past weekend. It was just a delayed party, delayed 12 months.
And happy birthday. So when we take a look at it, we see that we had two versions of the CARES Act in March and April of 2020.
Yep.
That totaled an enormous amount of money, 2.8 trillion. It was 2.3, then 500 billion, $2.8 trillion, an insane amount of money. By the fourth quarter, that had petered out. When we take a look at the GDP numbers for the year last year were 4.3%. But in the fourth quarter, on an annualized basis, it was only 1.9%. So we got a big rush and it petered out. Now, here we are in 2021, and we're at it again. In December, we did 900 billion. In March, we did 1.9 trillion, an insane amount of money. Coincidentally, it totals exactly the same $2.8 trillion we were talking about. So if the playbook remains the same, by the fall, we will start to see the effects of this wear off, and interest rates should come back down. Now, this is potentially the playbook. We have to think about, will there be this enormous infrastructure bill that they put together with more stimulus? Possible that happens, but we don't know. That's the unknown. If we don't see that, I think you're going to be seeing much lower rates towards the end of the year. But in either case, it really opens a playbook for 2022, 2023 recession-like conditions, which means much lower rates. So just like Katie, when we were together, I remember we were together in Vegas and doing the events there with you guys, and we had done several together, and we talked about in 2019 for the whole year, you don't want to be paying a lot of points. You don't want to be choosing upfront MI. You want to be choosing monthly MI. You don't want to look for the lowest rate. You would be willing to take a higher rate if it could reduce fees. Why? Because there's typically, while you're taking a monthly payment, you're still better off for 3 or 4 years until you've made more in monthly payments than the upfront cost you would have had. And we didn't think that you'd have the same mortgage for 3 or 4 years. We feel kind of the same thing right now. Okay. We think that there's a really big opportunity to refinance within the next year or two. Don't feel bad about doing rates over 3%. You're just planting the seeds today for tomorrow's refinances. So as you talk to your customers, keep this in mind, because it will serve you well, it'll serve them well, and then you've got a refinance on top with them to bring them to a lower rate, but save them money in the interim.
Which lends itself to the conversation that you guys have all the time, that we talk about regularly. Follow up with your consumer, especially in a market like this, is critical, because there is going to be ongoing opportunity over the next couple of years. I think last year, a lot of people thought, if I can just get through 2020, it's the refi boom, and then rates are going to jump back up, and then I don't have to worry about it for the rest or the next 5 years, 10 years, 15 years with those customers, and I can focus on bringing new ones into my sphere of influence. And really what you're saying is, no, everybody that you've talked to, everyone that you're going to talk to in 2021 is likely going to have an opportunity in 2022 or 2023 based on some of those early indicators that you were talking about. So
yeah, I do.
The stimulus package being one of them, right? What other things should we be watching out for that are going to be drivers of a rate environment in 9 months or 12 months or even 2 years from now?
So if I may, I'd like to start with right now, because rather than feel as if we're going to be in a position where, we have to tolerate this slow period until rates come down, you can be crushing it right now. If you just do 2 things. You have to take what the defense gives you, to use something like a football analogy. And what I mean by that is, right now people have a lot of debt, but they've also gained a lot of equity in their home. Okay. If you look at levels of appreciation, so what should we be doing? Debt consolidation. Don't look for rate and term. If you consider the way to do debt consolidation the right way, what you want to do is you want to reduce the term and help people build for their financial future, whether it's their retirement or their kids' college. And it's very appealing. You can take the same payment somebody's making today, mortgage, even if it's a lower rate, with all their debt, and then put them in a higher rate mortgage encompassing everything. And what you'll do is you'll wind up saving them lots of money, probably over $1,000 a month, which is worth considering. But since they're comfortable making the payments today, rather than pocketing that, if they took that difference and applied it towards principal acceleration, what you can do is you can have them do it voluntarily, or you could build it into the loan and reduce the rate further for the shorter term. You can wind up saving them 10, 15, 16, 18 years of mortgage payments. And by doing this, you completely change their financial future, all by making the same exact payment they're making now. They're just doing it more wisely. We got people telling us they're doing 10, 15, 20 transactions a month using this strategy, and oftentimes taking people to rates that are not lower, to rates that are actually higher. And remember, anybody that you've done a loan for in the past year with MI is now a candidate for a refinance, because you can do that MI. Another big point of friction that we're seeing right now is, as we all know, we want to do purchases, but you can't just say, okay, I want to do purchases. It's not easy. The best entrance you can get into the purchase market is by alleviating a huge point of friction. And there are 2 right now. The 2 points of friction are A, buyers who are finding that it is difficult, and it is, to purchase a home are getting discouraged. And two is there is approximately 60% of transactions that have bidding wars, all at the same time as you have fintech exploding. They're all loaded up with public money. They're making their entrance into both real estate and mortgage. So their footprint is certainly being much more uncomfortable for us. And in addition to that, as we go through the problems that we're seeing on the purchase side to help people with mortgages, 22% of closings are cash offers, are cash transactions, which means probably between 25 and 30% of the offers that are out there are cash. So these obstacles and points of friction can be resolved by doing a couple of things. One, on your purchase transactions that are seeing multiple offers, you need to be able to explain to individuals why it might make sense for them to contemplate bidding over the asking price, because that's how you win against the cash offer. Look, you got a cash offer. How do you beat a cash offer? There comes a point in time where there's a price where, okay, the seller will trade certainty at cash at this level for a 98% chance that that mortgage is going to go through at this level. So it's 100% here, 98% here, but I'm getting a lot more money. I'll probably take this offer, right? In many cases, that will win. In addition to that, even if you're competing against other offers with mortgage, you have to be able to have your buyer win the deal. You don't buy a home today, you win the home. And the way to do that is we've got that bid over ask tool, which people are going nuts with because it shows how long it will take. And this is the big answer. This is the big question. People want to know the answer to, okay, if I bid over asking price, at what point in the future will the value of my home eclipse what I've, in other words, when will I be in the black? I'm in the red here,
right,
but when will I be positive? When will I not be underwater on the value versus what I paid? I want to be on the plus side. And in so many cases, it's 4, 5, 6 months, which if you take the 2-month waiting period between offer and closing, 3 months after I close, I'm in the green. That's a good thing. I'm positive. That's good. I could deal with that. But what if it's 5 years until you reach the level? Because rather than just guessing willy-nilly what I should bid, you now have an ability to really help people make the correct bids and the right offer on a home. Realtors are gravitating to the answer to their prayers. And the other one is with those discouraged buyers, what you have to do is you have to use a cost of waiting analysis that we provide that shows you the exact appreciation in your zip code as well. But that cost of waiting analysis then shows that buyer who's saying, oh, maybe I'll come back in 6 months. Well, wait a minute. If you come back in 6 months, it's going to cost you $18,000 more. You sure you want to wait? I know it's hard, but stay in the game. You're better off today offering $10,000 over asking than waiting 6 months and now being upside down to $18,000 and then perhaps still have to go over asking. Katie, one last point on this. The real estate market's going to remain hot. You know, I look at demographics. We were the first ones to introduce that. Now it's interesting. After I've been doing it for so many years, some people are discovering this, but demographics are important. Look at birth rates from 33 years ago because that represents today's first-time home buyer. First-time home buyer is important because they deplete inventory without a home to sell, so they remove inventory. First-time home buyers who were born today were born on average 33 years ago, and that would be 1987, 1988. Yep. The subsequent 3 years, there was an explosion in births, which means we are about to be hit with an explosion of first-time home buyers over the next 3, 4, 5 years. So if you think the real estate market's hot now, it's going to get hotter. This is a good time to get in. You're going to see appreciation. And then there's a whole other topic of affordability. It is still very affordable. In fact, the 7th most affordable market. People don't know how to do the math on affordability.
So you brought up a really interesting point that I don't think people touch on a ton. Everyone's talking about, like you said, demographics. It's millennial home buyers that are now those first-time home buyers that are entering the market. That being said, they're also entering the market later than other generations have in the past. So I'm a millennial. I just turned 31 last weekend. I bought my house when I was 26. I was the only person that I knew that was buying a house. All my friends are buying houses now. So it is literally the entire generation from mid 80s to early 90s. There's a 10-year stretch where everyone is starting to look at it and say, all right, now might be the time to settle down. I've done the city thing for a while. I've delayed getting married a few years beyond what we've seen for other generations previously. I'm having kids a little bit later. All of that stuff is contributing to the fact that we're compounding first-time home buyers in a market with baby boomers that don't necessarily want to sell or downsize yet. So how do we manage inventory, or how do brokers help their buyers, their customers, understand and navigate a lack of inventory that we're seeing across the country?
So first of all, you nailed it, Katie. It's exactly right. That's the exact time frame, and that's exactly what's going on. The median is 33 years old, but certainly there's going to be some exceptions on the younger side, people that are more advanced like you, but there are certain people that are going to be a little bit later. But right around exactly the time frame that you gave is what we're seeing the sweet spot is for those buyers. And once again, with birth rates, we know from 33 years ago, 32 years ago, 31, 30, 29 years ago, it exploded. Those people will be coming in full force. It does pose the problem that you said. How do we manage that inventory was your question. It's very difficult to do so. So the way to navigate is exactly what we said. You have to explain to people why they should be at least contemplating and evaluating if it makes sense to bid over asking. And by the way, I know that could potentially pose other areas of heartburn with will it appraise and this and that. So it's not like I'm insensitive to that. But you got to put a stake in the ground somewhere to at least model it out. And then as those problems, the second tier of problems potentially arise, we'll have to also evaluate and contemplate how to figure those out. But at least initially, you have to figure out, does it make sense, just at least on paper, on a appreciation standpoint, if this is a good financial decision or not. So that's the first way to do it. Yep. But we also have to explain to people that regardless of the negativity in the media, which has been around for so many years, this is a great opportunity as far as an investment goes for you and your family. This is one of the best investments that you can make today is in real estate. So this is the best way for us to help our buyers navigate through this, is to explain the opportunity. And then if they're willing to move forward based upon that evidence, will be a great asset to realtors, will be a great, because people could buy a home today. It's just, do they want to pony up for it? That's the question, right? You can buy, you just have to, in many cases, bid over asking price to pony up for it. It's difficult, but it's doable.
So that brings up an interesting point as well. I posted in our Brokers Are Better group the other day talking about the fact that you and I were going to jump on today. And we had a handful of people, we had a lot of people that jumped in with questions. One of them relating to exactly what you just referenced. Typically in the spring and going into the summer, we see an expansion of inventory available. People are ready to move. It's summertime. If their kids are changing schools, now's the time to do it. What do you think the next 6 months are going to look like with inventory? Do you think we're still going to see this really aggressive competitive market? Are we going to start to see more houses come on the market because people are ready to make a change? Are we going to see less houses come on the market because they feel like the value of their home is going to continue to rise at an escalated pace, so they want to sit on it for another year? What is the summer going to look like for us?
Tight inventory. It's tight because remember now, a move-up buyer doesn't alleviate inventory. They can create more transactions. Mm-hmm. But they're also, that person who's putting their home up for sale is more than likely going to purchase a home. So the move-up buyer is not solving your inventory problem, although they are creating some more transactions, right? So there's two different areas.
Yep.
That first-time home buyer, which we just talked about, they're the ones depleting inventory. They're going to deplete it at a higher level and a more rapid pace this year, next year, the year after. So this is going to create some difficulties for us in managing that. So the inventory situation, unfortunately, is going to remain very tight. And let's hope that the powers that be in Washington don't make the very, very foolish mistake of offering this ridiculous $15,000 credit to first-time homebuyers, because goodness gracious, if they only could understand that the problem is not a lack of first-time homebuyers, because that's what the incentive would be. The lack is product. So why is there such a lack of product? Regulation, land restrictions, land availability, and the costs to build, which includes lumber prices that have tripled. And the latest numbers from the National Association of Home Builders is where they claim that that's a $24,000 increase. So what's happening here is that we are seeing homes on the higher end being more available because it's more profitable and easier to construct those homes and take into consideration the costs than it is the lower priced homes, which you have a smaller margin, of course. The solution would be to subsidize, let's just say, here, my idea is this. Okay. If you're a builder and you want to build a home that is, in your market, take the median home price, you build below 80% of the median home price. So if the median home price is $300,000, if you're building homes below $240,000, let's take that $15,000 and help you to keep that price under $240,000 so that we can create the product that we desperately need. Don't give it to more buyers. Look, Katie, we saw this in 2009 and 2000. It was a disaster. And that was with a lot of inventory. It was that people got left holding the bag. It just pushed prices up parabolically. And then right after the tax credit ended, who wanted to buy a home then? Nobody. So we saw prices decline and people were upside down. So it was a terrible idea, and they want to go through the same bad playbook.
So you just referenced the recession that we saw 12, 13 years ago, 10 to 12 years ago. There were early indicators at that point in time that we were going to see the market that we did, but not everybody was paying attention to it. There were a lot of questions that came through in that Facebook post that I just referenced about the same topic. Are some of those same indicators creeping in now? You just referenced one, right? A specific decision, legislation that's going to impact the industry. What else is happening, or what else should we be keeping an eye out for to see if that's the direction that we're headed again?
A lot of things, and obviously the AIME community is very astute. There's a lot of really smart people here, and you guys do such a great job of keeping people in the know. But they're right. We are looking at a lot of indicators that point to a 2022, 2023 recession. The biggest one is debt. So we talked about how the debt wears off. We talked about GDP, declining. And I mentioned what it was. Now the Atlanta Fed, they just took their first quarter GDP with all the stimulus. The estimate was for 5.6% annualized. They just took that down to 5.4. So they're already starting to drop their estimates. And that's with 2.8 trillion in the first quarter of this year towards stimulus. Without it, we'd be in a recession now, right? So there's no doubt about it. We would right now be in a recession if it weren't for all of this stimulus that's being poured in. So what's going to happen is, as the stimulus wears off, the tide's gone out. You can see the emperor has no clothes. The economy is not moving at the level it needs to, and the level of debt that we're left with is like a family that's indebted themselves with all kinds of debt service that they've got to do. They've taken out so much debt, they're living off their credit cards. And now initially when they got all the money on the credit cards, we had a party and we spent all this money. But now that we've spent it, all that's left is the debt, and debt slows growth. We've seen that everywhere in history, everywhere in time. It's one of the things we looked at to correctly forecast the 2020 recession, which happened January 31st. Before all the lockdowns. We nailed that. We got that right. We're seeing very similar signs, as your followers point out here in the community, that we are seeing something really similar for 2022, 2023, and that is always accompanied by very low rates.
So what can brokers do to prepare for that? We're talking a lot about what's going to happen, some of the challenges or opportunities within the industry as it stands today. What can they be doing in 2021 to prepare for the market that you're predicting for 2022 and 2023?
I always, when I did mortgages, which was for 21 years as an originator, I always did 2 loans at a time. And you do the loan you're doing today, not as a standalone. You want to contemplate this loan and how it fits like puzzle parts to the very next loan I'm going to be doing for you. So the first thing is, I've got to ask a lot of questions from you with regards to your personal situation. Do you expect your income to grow? Do you expect your income to decline? Maybe that could be if they're planning on having a child. Yeah, if someone's graduating or moving to a certain level or expecting an increase or expecting a promotion, their income could grow. Is your family size going to grow? Is it going to decrease? There are lots of things to contemplate. And then, are you set up for your kids' college? Are you set up for your own retirement? And let's try and figure out a way for us to use this amazing financial tool to fit that. But also, what are the economic circumstances, many of which we just talked about? For example, we believe that within the next 2 years, there will be a really strong probability you're going to refinance this mortgage. So why in the world would we pay 2 points or 3 points on this thing? Because it's going to take us 5 years to break even on that. You're going to refinance out of it. Why would we pay upfront MI instead of monthly MI? Now, upfront MI sounds sexier because your payment's less. But if you can afford the monthly payment, you're better off for over 4 years. You're not going to have this mortgage for 4 years. So you will have saved a couple of $1,000s in many cases that way. That's what a smart advisor does. And while everybody's out there hawking the lowest rate or looking for the lowest rate, that's the wrong strategy. The wrong strategy, if you're only going to have this mortgage for 2 years, is to sacrifice the lowest rate, take a higher rate in exchange for lower fees, because it would take you 4 or 5 years to recoup that money. So you're paying into something that you'll never pay off based upon the fees that are out there. So you'll be better on that side of the transaction, given the fact that you're going to probably refinance this thing soon.
So you talk a lot about being an advisor, right? Not literally a financial advisor, but kind of, right? It's how
literally,
do you
literally, yeah, literally.
Obviously, you guys have you have certified mortgage advisor that is connected with MBS Highway that you founded. What are some of those key things that brokers, whether taking your course or trying to learn on their own, that they should be learning so they can have the types of conversations that you're referencing?
The goal when I created CMA was so that you could sound like me when you talk to your customer, when you sound like...
I want to sound like you, Barry, honestly. You really do.
Thank you. You're very kind. But to sound like that to your customer, to sound like that to your referral source, and to sound like that in the media, or when you're on the web creating videos and content, so you can have that command of respect and trust that you could build based on the fact that you are viewed as the expert. You're viewed truly as an advisor. And that overcomes a lot of rate issues. Listen, Katie, let's think forward now, right? Today, do we really think we're going to win a price war? We're not, okay? It's just, that's the fact. We can't be the cheapest every single day out there. We're not going to win in price. Somebody's always going to be cheaper, whether they can truly deliver or not, and what the fine print is. Customers aren't going to know that. Do we really think that if we could do a transaction slightly quicker than somebody else, that we're going to be able to win that every day? We see how quickly technology is growing. So where can we win? There's only one place, and that's right between our ears. That's making the investment in the most important asset we have. It's our brain. The tools that we use are our words. Those are the tools. So if we can have the intelligence and the knowledge and the sophistication, and then you articulate it with the words that can help your customer really get it and understand it and see that by dealing with you, your experience with them is going to be life-changing and meaningful, as opposed to saving them $13 a month or $25 a month with somebody else who isn't going to strategize. Look, the lowest rate on the wrong strategy is so much more expensive than a competitive rate on the right strategy and game plan on the most important financial transaction they're making. So we have to make that meaningful, and we can't go through the motions anymore. This is not shooting fish in a barrel. You can't be a headset jockey. You can't lie now. You can't say, oh, I am an advisor. You have to really be that. You can't give what you don't have. So things like fintech companies manipulating APR. I mean, people that are watching this are getting screwed over. Their customers are getting screwed over because fintech companies know how to manipulate APR and make the wrong mortgage look sexier in the eyes of the customer, but it's a terrible deal. If you can decipher that, if you really understand that, then you could win those. We have to understand planning for that client's future. There are so many things: understanding the bond market, the Fed, technical analysis, reading the charts. Amy, it's so crazy, right? So what we'll see happen is rates will go up for a few days like we saw, and then people come out of the woodwork and say, well, that's why I lock everybody. Well, how'd that work out for you for the past few years, right? Horribly, okay? So you messed up every transaction you had. You pissed off customers and referral sources, and you lost money and reputation. Why? So that this week locking everybody or floating everybody is wrong. Having strategy and helping with what the correct approach would be is what people depend on you for. Does that mean you're right 100% of the time? Of course not. But what it means is that you're not a robot. The less advice you give, the less of an advisor you are. And by definition,
right.
the more people can go elsewhere and justify, well, I don't need you. I could just go online and get something. Okay, I could do this robotically if you're not going to provide any value. Just think about what we need to do right now is truly provide value. And that doesn't come in the way of expediting the transaction. It comes in the way of strategizing the transaction.
I mean, you've said it, we've said it, create value, value will follow. You talked about it at the EPM event that we were both at last weekend. We talk about it regularly. When you create value, when you give people a reason to trust what you're saying and they understand why you're saying what you're saying, they're more likely to continue to be engaged with you over the long term instead of looking at it. We don't want to look at customers as individual transactions. They should be relationships. It should be, a customer for life mentality where we want to keep people coming back. And you can only do that if you earn their trust up front the first time. It's not something that you're going to have the opportunity to do on transaction 2, 3, or 4 if you didn't build the trust in transaction 1. So all the tools that you guys have, clearly ways that you can do that, help articulate a sentiment to a customer, make sure they really understand the why and why what you're saying is so important and the impact that it can have on their life that goes far beyond, can I get a rate at 3% instead of a rate at 3.25%? It does. It makes a huge difference over that person's lifetime.
Katie, as always, yes, you nailed it. But I want to also mention one thing to underscore what you said about trust, because you mentioned trust, and trust is everything in a transaction. Now, Some people, no matter what you do, all they want is the lowest price. They think they know better than everybody else. Okay, that's fine. Okay, that's a percentage. But the vast majority will really welcome your advice and want that advice. And the first way to have them receptive to that is to build trust. You build trust 2 ways. The first way is with showing your knowledge, but you can't give what you don't have. You have to have done the work. You have to have the resources to show off that knowledge. And then people will begin to trust you because they can feel that they can learn from you. The second way to build trust is to not be afraid and tell them everything possibly bad about the transaction you could. The way to view your customer is if they were your parent, your child, your best friend, and if they're working with somebody else and they called you for your expertise and you say, here's what you need to watch out for. Here's the things that I've seen in my experience. Don't be afraid. Tell them everything bad. Be fearless, and you'll be rewarded with that customer's trust and more referrals. And then you take price and you make it less of an important issue. So education, and don't be afraid to tell them all the negative stuff so that they believe you and they trust you.
Absolutely. Barry, as always, it has been amazing having you on. We could have you on every week. Honestly, you're just infinite wisdom and education and value that you provide to our community. Before we go, is there anything that you want to leave the Brokers Are Better and the AIME community with? One piece of advice, one nugget of knowledge. What do you got for us?
So first of all, I love the AIME community. I mean, you guys, every time we go to an event, you guys are so kind to me. I love you guys. I mean, God bless you guys. I wish you guys just unbelievable success and health and good things. But the one piece of advice that I would have is your own mindset, because it's easy to in the next 30 days, start to get a little bit down because we've been so busy. Mm-hmm. And now, even though the origination side is starting to change a little bit, they're still busy in getting this through the pipeline. And then you still get the checks to come in. But in the next 30 days, we're going to start to say, I'm not as crazy all the time, or I'm not. So here's what's really critical. Change your focus. Your focus really needs to be on the things we talked about earlier: alleviating points of friction, doing debt consolidation, investing in your mind. Be the very best version of yourself. This is your time to do it. This is the time to work on your business and build it for the future. There's going to be another huge wave coming. So maintain the level of success by changing your focus today, but also be prepared for this incredible opportunity that's going to come in the not too distant future. I told you guys that was coming in 2018, 2019. It came. The same setup is about to happen here for 2022, 2023.
Y'all heard it here from Barry first. It's time to work on your business. You got to get started. We have to start doing it now. Otherwise, 2022 is going to eclipse us and we're not going to be prepared for it. So check out MBS Highway, check out Certified Mortgage Advisor if you haven't yet. Barry, as always, thank you so much. We will definitely have you back as soon as possible.
Thank you.
See y'all later.